Capital structure is the way a company finances its operations and investment through a combination of debt and equity. Capital structure is an important requirement in corporate financial management. The purpose of capital structure is to achieve an optimal structure, maximize the value of the company and minimize the weighted average cost of capital (WACC). An effective capital structure takes into account various risks, including systematic risk, interest rates, and market competition. Dividend policy is a company's strategy for distributing profits to shareholders in the form of dividends. This policy determines whether profits will be distributed as dividends or retained for reinvestment. Dividend policy is also the policy used by a company to determine how much of the profit will be distributed to shareholders. Dividends are usually paid in the form of cash or additional shares and are not necessarily paid regularly. Uniqlo is a Japanese clothing brand known for its high-quality casual clothing at affordable prices. Uniqlo was founded in 1949 as a textile manufacturer. Uniqlo has become a market leader in Asia and is expanding internationally. Uniqlo's business model is the SPA, Specialty Store Retailer of Private Label Apparel concept, where the company has full control over the operational level. This allows Uniqlo to maintain consistent quality, be able to respond quickly to market demands and offer reasonable price. Uniqlo also emphasizes the value of simplicity, quality, and environmental sustainability. The Uniqlo recycling program is one of the company's initiatives that shows that the company is trying to reduce its impact on nature. Uniqlo now continues to grow as a global brand that is trusted and loved by many in various countries.
In 2021, Uniqlo demonstrated a strong liquidation position compared to 2022, as shown by higher current, quick, and cash ratio. The current ratio of 2.97 in 2021 versus 2.48 in 2022 indicate that Uniqlo had more current assets to cover its short-term liabilities. Similarly, the quick ratio decreased from 2.29 to 1.93, showing reduced liquidity without relying on inventory. The cash ratio also dropped from 2.03 to 1.55, reflecting a weaker immediate cash position in 2022. Overall, Uniqlo was more capable of meeting its short-term obligation in 2021. In 2022, Uniqlo showed an improvement in its solvency position compared to 2021. The debt-equity ratio decreased from 1.16 to 0.97, indicating reduced reliance on debt and stronger equity position. The total debt ratio also dropped slightly from 0.54 to 0.49, suggesting a lower proportion of assets financed by debt. Additionally, the time interest earned ratio increased from 35.58 to 39.33, showing Uniqlo improved ability to meet its interest obligation. Overall, these changes reflect a more stable and financially secure position for Uniqlo in 2022. In 2021, Uniqlo managed its assets more efficiently than in 2022. As reflected by higher asset management ratio, the inventory turnover was 2.68 times in 2021 compared to 2.25 times in 2022, indicating faster stock movement. Receivable turnover dropped from 42.20 times to 38.23 times, showing quicker customer payment in 2021. Total asset turnover also declined from 0.85 to 0.72 times, suggesting less efficient use of overall asset in 2022. Likewise, fixed asset turnover decreased from 12.68 to 11.77 times. Overall, Uniqlo utilized its asset more effectively in 2021 than in 2022. In 2022, Uniqlo showed improved profitability in some areas compared to 2021. The profit margin increased from 8% to 12%, indicating higher earnings from sales. Return on asset also rose from 7 to 9%, showing better efficiency in generating profit from total asset. However, return on equity declined from 50% to 9%, suggesting decrease in the company's ability to generate returns for shareholders. Overall, while Uniqlo became more profitable in terms of sale and asset usage in 2022, it delivered lower return to its equity investor compared to 2021.
Uniqlo has made strategic improvement in its capital structure. The debt-to-equity ratio decreased from 1.16 in 2021 to 0.97 in 2022, which shows that the company is relying less on debt financing. This reduces financial risk and increases capital stability. The times interest earned ratio rose to 39.33 in 2022, indicating that Uniqlo has a strong ability to meet its interest obligations. Additionally, the debt ratio dropped to 0.49, meaning only 49% of the company's assets are financed by debt. This reflects a more balanced and healthy financial management strategy. When it comes to dividend policy, Uniqlo maintains a consistent and transparent approach. The company pays dividend twice a year, 280 yen per share before the end of the fiscal year, and 340 yen after the year ends. This totals 620 yen per share annually. This policy ensures shareholder satisfaction while also allowing the company to retain enough profit for future reinvestment and growth.
Factors influencing Uniqlo capital structure have three: maintaining a healthy balance between income and liabilities, how the company chooses to finance its assets, effective liquidity and cash flow management. By using the DIE ratio, this will be to indicate how many times company can cover interest obligation with its operating. So the higher DIE ratio will be such as strong operational performance and ability to meet interest payment with easier. Next is how the company chooses to finance its asset. It's about the total debt ratio. We'll be indicating that this strategy decision underscore Uniqlo preference for internal financings or equity capital to support business activity. Lastly is effective liquidity and cash flow management. Meet short-term obligations without relying on external finance, and it will be predictable economic environment. Having ample liquidity enables Uniqlo to respond swiftly to challenges and opportunity. The impact of the recent economic conditions on capital structure of Uniqlo, we can see that the financial leverage has led many companies, including Uniqlo, to reduce their reliance on debt financing to avoid being burdened by high interest expenses. Second, Uniqlo financial strategy includes holding high levels of cash and liquid assets to enable quick response to market changes, fund expansion initiative, and cushion against economic downturns. In an ever-changing the global economic environment, companies must continually assess and adjust their capital structure to ensure financial sustainability and long-term growth. So the example of company adjusting capital structure to market condition based on Uniqlo, this is a company based on fast retailing, has consistently demonstrated prudent financial management by adjusting the capital structure to respond to evolving market conditions. Also, during the time economic uncertainty, they have a company preserve liquidity and emphasize financial stability, showcasing its commitment to long-term resilience. It also maintained the low financial leverage, supported by substantial cash reserve and steady cash flow, which allowed it to avoid excessive debt and remain operationally agile. In response to shifting market dynamics, Uniqlo also restructured its debt to optimize financial costs and sustain operational efficiency. Moreover, the company has prioritized shareholder value through strategic share repurchase and consistent dividend payment, reinforcing investor to confidence. It will be a strong credit rating for the highlights its financial disciplines and provides the flexibility needed for future strategy investment.
Next, I will explain about research question 4, dividend policy, a strategic balancing act. We choose case study for Fast Retailing and Walgreens. I will be presenting how Fast Retailing and Walgreens manage their dividend policy. We will explore how financial performance, market condition, and strategy influence the dividend decision. Dividend policies are crucial in balancing shareholder returns with the company's long-term growth. Companies must weigh current profitability, future investment needs, and cash flow before deciding on dividend payouts. This decision reflects management's confidence in the business and shape investor perception. Let's start with fast retailing. The parent company of Uniqlo follow a balanced approach, paying dividends twice a year, which is interim dividend and year-end based dividend on performance reviews. In April 2025, they increased their projected annual dividend to 450 yen to 418 yen per share. This decision was backed by strong financial results and optimism about future earnings, reflecting their commitment to stable return while expanding globally. On the other hand, Walgreens, a major United States pharmaceutical company, suspended its dividend in 2025 for the first time in over 19 years. This was due to rising operational costs, high interest debt, and internal financial pressure. This move highlights how dividend payments depend not only on profitability but also the company's cash flow and financial stability in times of crisis. This chart summarizes the contrast. Fast retailing increased dividend due to growth and confidence, while Walgreens suspended them to prioritize restructuring and stability. It clearly shows how dividend strategies align with both the company goals and market conditions. In conclusion, dividend policies serve as a signal of financial health and strategic intent. Fast retailing demonstrates how consistent performance supports shareholders' return. Conversely, Walgreens shows that during difficult times, companies must prioritize long-term survival over short-term rewards. Both examples emphasize how dividend reflects more than just profit; they reflect direction and resilience.
Next is research question number 5. Uniqlo balanced their need for growth and investment to pay the dividend to the shareholders by using constant dividend payout ratio that's decided by the board of directors of the company unless it has changes in laws and regulation. For example, Uniqlo pays the dividends to their shareholders twice a year with a fixed ratio, which is 280 yen per share before at the end of the year and 340 yen per share after at the end of the financial year. Second, Uniqlo used the stable dividend policy regardless of short-term earning fluctuation. This builds investors' confidence with their companies while allowing flexibility for reinvesting in the company. Uniqlo will effectively utilize internal reserves and free cash in financial investment. Next, Uniqlo has always ensured that the fund required to maintain and grow the group's business are stable and fast, and it strives to maximize free cash flow from business activities and effectively utilize internal and external funds. Uniqlo plans to diversify financing and improve capital efficiency, as well as use several corporate bonds to raise capital. For example, Uniqlo raised 250 billion yen using corporate bonds to expand its business to overseas and promote the ERIC project in June 2018. Besides that, Uniqlo also provides stable and sustainable returns to their shareholders even in periods of economic uncertainty or temporary profit fluctuation.
Conclusions: Uniqlo's capital structure and dividend policy shows that the company adopts a prudent and strategic financial approach. Uniqlo is working to reduce financial risk and ensure long-term operational stability. This move also demonstrates the company's ability to adapt to uncertain economic change. Uniqlo also emphasizes shareholders' satisfaction through consistent and stable dividend payments throughout the year. At the same time, strong cash flow and liquidity management allow Uniqlo to continue investing in international market expansion without relying on external financing. Uniqlo's approach to managing its capital structure and dividend policy demonstrates the company's ability to adapt to current economic challenge and maintain sustainable growth.